Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at three cheap, or I guess you could call them lower priced stocks to buy to start the year 2022 as we're in the new year. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our new Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump into the three cheap stocks to consider buying that are also highly ranked Zacks stocks to start the new year, we're going to take a look at the broader bullish case for the market as we head into the start of a brand new year of trading. So the S&P 500 notched its 70th record close of 2021 during the last week of the year as part of a roughly 27% climb during the year. The benchmark index posted double-digit gains for its third year in a row, and history suggests Wall Street could be headed for another solid showing in 2022. We also saw then stocks hit new highs on Monday. With that said, the NASDAQ was down about 1.6% through early afternoon trading on Tuesday as people take some profits early on in the year. With that in mind, Wall Street Journal's story on Monday noted that the S&P 500's recently completed three-year run of about 10% or of 10% or higher gains has happened only 4 other times. The index went on to finish higher in 3 out of those 4 cases. Plus, the S&P 500 has jumped at least 10% in a quarter 24 times since 1980, which includes Q4 of last year, so Q4 of 2021. The benchmark then posted a green quarter in 20 of the next 23 quarters. There are, of course, plenty of obstacles to overcome in 2022, including rising prices, COVID, tapering, projected interest rate hikes in the second half of the year. Plus, we are sure to run into some unknowns. That said, the U.S. economy is rebounding and money dove back into stocks once it became clear the U.S. was not headed for another round of major lockdowns amid the Omicron wave. This time around, it seems that more key decision makers appear focused on keeping the economy running amid lower hospitalization rates and signs of milder symptoms. So on top of learning to live with COVID, the bullish case for 2022 remains somewhat straightforward when taking a more holistic view of the other market moving forces. So the outlook for S&P 500 earnings and margins remains solid and resilient despite inflation. Plus, the market is not as overheated as some might assume. The S&P 500 is trading near its 2-year median at 21.8 times forward 12-month earnings. The benchmark now sits around where it was in July of 2020 in terms of forward earnings, at about 15% below last summer's heights. So the summer of 2020 at this point in terms of valuation, despite trading at new records. This highlights the positive outlook for earnings we just mentioned and demonstrates that Wall Street has already cut down a ton of overheated stocks to far more reasonable levels. With that said, tech valuations are a bit more stretched compared to sectors like financials and energy and other sectors. Still, it's hard to imagine investors will move out of equities and therefore out of tech stocks in general, given that interest rates are poised to remain historically low for the foreseeable future, even when the Fed starts to raise them, unless inflation goes kind of completely out of control. So for instance, the 10-year Treasury has rarely and barely moved above 3% since the financial crisis. And if rates were pushed back up to 4 to 5% levels of the first decade of the 2000s, it might make stocks look a lot less desirable necessarily, but it also make U.S. debt servicing costs far more daunting. Meanwhile, U.S. bonds, even at their current levels, with the 10-year at about 1.6% at the moment, are far more appealing compared to the near zero or negative rates in other major economies such as Germany or Japan. All of these factors should keep U.S. rates relatively and historically low, which is bullish for stocks in the long run. So with this in mind, here are 3 top-ranked low-price stocks to consider buying as we start a brand new year. And the first stock up is LendingClub, which trades on the ticker LC. The company went public in 2014 as a purely digital peer-to-peer lending firm. LC struggled out of the gates for various reasons, but the firm found new life amid the global fintech boom, and LendingClub has changed its long-term trajectory when it purchased Radius Bank Corp in the early part of 2021. LendingClub is now a diversified web-based lending company that allows customers to take out loans for almost any purpose, from auto loans and other large purchases such as home improvements to paying down credit card debt. The firm normally allows people to borrow up to $40,000, typically with a fixed term and fixed interest rates on regular monthly payment schedule. The company boosted its long-term outlook, as I mentioned, when it bought the digital-only bank Radius Bank Corp. The acquisition, which closed in February of 2021, enabled LendingClub to keep more of its loans that it generates on its own balance sheet. The practice allows the firm to collect recurring interest income instead of simply selling off all of its loans that it generates. The deal also provides it a more direct pathway to becoming a modern digital-based bank with a consumer focus. The company utilizes its AI-driven, what it calls credit decisioning, in machine learning models to help determine what customers it will provide loans to. The company boasts that its model helps it offer lower credit rates while also reducing its delinquency rates. It says it's 35% lower delinquency rates compared to the competitive set within the industry. With that said, since its founding in 2007, it has nearly 4 million members taking out various loans. The company's growth potential is rather large in a world that's driven by credit and digital financial services, both large scale and on the consumer level. Its digital focus will also help it grow, and the firm is already seeing half of its members come back for a second loan, which is really key for its growth. Its CEO said on its earnings call last quarter that it's benefited since its loans originate at a fraction of the cost compared to loans to new members. So as more people are coming back for second loans, it's way better for the company as well. The revamped LendingClub is also currently expanding its portfolio with newer products. These include auto loan refinancing and its entry into the red-hot buy now, pay later space. More broadly, the revamped LendingClub aims to offer a broad range of products to help its consumers really manage lending, spending, and saving. So they're trying to become, as I mentioned, a more just broad-based fintech player. The company topped their Q3 estimates at the end of October with revenue up about 250% year over year and 20% sequentially. The company's deposits grew 12% to $2.8 billion, and it crushed our adjusted earnings estimates. Looking ahead, Zacks estimates call for its fiscal 2021 revenue to soar 156% from $314 million all the way up to over $800 million. Obviously, a lot of that's boosted by its acquisition. With that said, its 2022 revenue is set to climb another 41% higher. So that's with a whole year of Radius included, all the way up to $1.15 billion. So about $1.2 billion in 2022. It's also expected to swing from an adjusted loss of $1.53 per share last year to 9 cents per share this year, and then skyrocket 1,800% to $1.72 per share in 2022. Also, its consensus earning estimates have climbed since its last report to help it land a Zacks Rank #1 strong buy right now. And its shares are trading at a nice discount to where they were. So LendingClub shares had skyrocketed, which included a huge post-Q3 release surge from around $32 a share to nearly $50 in only a few sessions. So that was in the fall. The stock currently is trading, though, at about $25 per share, so far more reasonable levels. And this is as people just instantly sold off that massive, way overdone post-earnings move, with the Zacks consensus price target sitting at $46.25 per share, which marks 85% upside to its current levels, as we mentioned, at about $25 per share. The stock is currently hovering right above its 200-day moving average, and it popped out of oversold RSI territory. It's now sitting at about 37, with 30 being that oversold level and 50 being neutral. So plenty of more room left to climb. And overall, LendingClub is part of a larger group of fintech companies that's expanding their scope in an effort to become something akin to a modern digital native bank that's poised to thrive in our really digital everything world. So LendingClub certainly worth considering, trading at $25 a share, which is way below its price target, and considering its growth aspect going forward in a space that's just continuing to grow in our fintech and digital everything world, especially digital money. Now we're going to move on to a company everyone has heard of, certainly everyone in the U.S. and most people in the world have heard of, and that is Ford Motor Company. Ford led the charge during the original automotive revolution. Clearly, it wasn't first out of the gates in the electric vehicle race, but that doesn't mean Ford can't thrive, and its stock price has soared amid its EV push. And Ford has really dove headfirst into EVs under its new CEO, Jim Farley, who took over officially in October of 2020. Ford and its new chief executive are working on 3 broad goals to bring the historic automaker into the future. The focus will be on EVs and accompanying digital services for its tech-filled vehicles. And the last major effort is to boost its electric appeal and relationships with an array of commercial customers, from contractors and construction companies to police departments and other government fleets. So Ford is currently the nation's number 2 automaker by sales, and it's already rolled out an all-electric version of its famous Mustang, which is the Mach-E. And the firm really turned heads when it showed off its F-150 electric version back in May of 2021. And the company is also launching an EV line of its best-selling commercial vans, dubbed the E-Transit. Its commercial business could really set it aside and bring in more recurring revenue as companies pay to monitor their connected fleets. And Tesla might have been the number 1 EV company, and it might never be able to compete, though, against Ford in the truck space, because Tesla chose its own fate when it decided to tease a space-age looking futuristic truck that's still not available yet, instead of going the more traditional route that Ford is going, which would be more useful to people who want to own a truck. So by contrast, the Ford F1 Series last year remained America's best-selling vehicle for the 39th year straight, and the top-selling truck for the 44th year running. So Ford's early EV efforts have already paid off. The F-150 Lightning quickly pulled in over 100,000 reservations, and the upside could be significant since 77% of those reservations were from customers new to Ford. And with that said, the company just popped 12% on Tuesday to over $24 a share, which was to new 52-week highs, because Ford said on Tuesday that it's doubling its goal for manufacturing the new version of the F-150 to 150,000 a year. Ford said the increased production plans reflect high demand for the model, so they have about 200,000 reservations so far for the opportunity to order one of the trucks. The first group of reservation holders will be able to place orders for the electric F-150 beginning on Thursday, the company said. The company also said that its F-150 Lightning will be starting at around $39,974, so basically $40,000, before potential tax credits, and the production of the electric pickup is expected to begin this spring. So they've already seen massive demand for a truck that's widely popular, and they're also seeing a lot of people who might not have even ever owned a Ford F-150 getting into it because it's an EV. And we should also note that its Mustang Mach-E, which is already out, was the number 2 seller in the U.S. among all EV SUVs, and it was named the electric vehicle of the year by Car and Driver last year. So already had some big success in its early days as an EV company. And it also still has some room to run before it runs into the $30 a share it traded back in the late 1990s. And it's already been on a big run so far this year, with the stock up 70% in the last 3 months alone. And it's up 180% in the trailing 12 months to leave the benchmark index and its own peers in the dust. So obviously this also includes that big 12% pop on Tuesday, trading at around $24 still just the share. With that said, on the valuation front, it's trading at 11.6 times forward 12-month earnings, which is still near its median and at a discount to its highs of about 13 times over the last 12 months. And this is despite, as we said, surging this whole time and now trading at new highs in terms of price. And it also marks a huge discount compared to its industry, which is trading at 33 times. So it's trading at 11.6, which is really solid. So with this in mind, the company's revenue is expected to climb 13% this year based on the most recent Zacks estimates, and then climb another 13% next year. And then on the bottom line, we're expected to see 360% adjusted earnings growth from 41 cents per share all the way up to $1.88 per share, excuse me. And then more growth coming in 2022 as well. And then on the bottom line, it's seen big upward revisions from before it reported its last earnings, and that positivity on the bottom line helps it grab a Zacks rank number 1 strong buy. We should also note that the stock has blown away our adjusted earnings estimates in the trailing 4 quarters at an average of 335%, which includes an 82% beat last quarter. So looking ahead, the company's plans are to just keep rolling out more electric vehicles. They've teased plans for versions of their Explorer as well as the Lincoln Aviator. Ford perhaps ambitiously said that it expects fully electric vehicles to generate 40% of its global sales by 2030. And the company is investing far more money on the tech side, which is vital to EVs since they rely heavily on interconnected tech and remote software updates. The company in early September even poached a former Tesla executive from Apple to help with these efforts. And Ford is also crucially planning to manufacture its own batteries. And it's still really the early days of EVs. So Ford has plenty of room to grow because electric vehicle sales only made up roughly 2% of all U.S. sales last year, in just about 3% in the last several months. So Ford, certainly a stock worth considering, even though it might be a little overheated and we could see a bit of a pullback given this massive run in the last 3 months that then also saw the stock jump just 12% in one day to about $24 a share. But long-term investors might still want to consider it, even though it might be a little bit overheated at the moment with that early run in 2022. And now we're going to end with one more company that's also Zacks ranked number one strong buy and trading for less than $30 a share, and that is Sonos, which trades on the ticker SONO. Sonos is a speaker company that competes against Bose, Apple, and others in the high-end home audio market. Sonos sells a range of sleek connected speakers, subwoofers, soundbars, and more. Its baseline speakers start at under $200, and packages can cost over $2,000. The company also sells what it calls architectural speakers that are more built into your walls or your ceiling, depending on where you want to install them. The company also last spring officially entered the popular portable smart speaker space with a $179 Roam speaker. It also has a non-speaker business that includes a streaming music service that also includes an $8 a month ad-free streaming tier that helps it compete against Spotify. And the company overall is set to continue to benefit from the larger shift to modern connected devices and a broader increase in at-home spending. So with this in mind, Sonos revenue climbed 11% in fiscal 2019 and then 5% in 2020. It then posted blowout 2021 results for the period ended in early October, with sales up 30% and its adjusted earnings skyrocketed. Plus, Sonos has built up a really loyal customer base, which is key, and it's full of repeat buyers. So the firm's total households climbed 15% last year to about 12.6 million, and its products per household increased all the way to 3. We should also note that Sonos executives raised their 2022 guidance in the face of global supply chain bottlenecks, and they said they're well on their way to their longer-term goals that they set earlier for 2024. So with this in mind, current Zacks estimates call for Sonos' revenue to climb another 14% this year, and then another 12% in 2023 to hit $2.2 billion. With that said, its adjusted earnings are projected to slip a bit compared to the tough to compete against 2021, but then they're expected to bounce back in a big way in 2023. Luckily, its overall 2022 and 2023 consensus earnings estimates have climbed in a big way since its last report to help it capture Zacks ranked number one strong buy. And it's crushed our EPS estimates by an average of 180% in the trailing 4 quarters. On top of that, Sonos executives announced a new stock buyback program in November. And in terms of price performance, Sonos, which went public in 2018, has surged 90% over the last 2 years. Luckily for investors who missed out on this ride, the stock's only up 22% in the past year. And Sonos currently hovers around 35% beneath its April records at $29.33 per share. And its Zacks consensus price target represents 60% upside to its current levels. The stock is also trading right near its year-long lows at 22 times forward 12-month earnings, which is nice in terms of the valuation. And this also marks a slight discount even to the S&P 500 and not too much of a premium compared to the industry, even though it's crushed its peers over the last 2 years. So with that in mind, Sonos is certainly another one of these lower price stocks that has a high Zacks rank that's within an industry that's set to grow. Its growth outlook's there, fundamentals are there. So we looked at Ford, Sonos, and LendingClub to start 2022 and all really look to be worth considering not only for 2022, but maybe as longer term holds as we head into the rest of the decade here. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.